In our previous analysis, I told you to watch the gap. I told you that while the COMEX was sleeping, the physical-backed crypto markets were giving us a real-time preview of the coming storm. Kinesis silver was trading near $100, Hyperliquid was at 96, and PAXG gold was at 5,400. This was happening while Western Spot had closed Friday at 93 on silver and 5,278 on gold. Those numbers were your preview. I said precious metals were likely to gap higher when markets opened, and that is exactly what happened. Silver gapped from $93 to nearly $97, and gold punched above 5,400. But here is where today gets complicated and far more important than the gap itself. As of this recording, silver has retreated to $90 and gold is sitting at 5,346. The story of why this reversal happened and what it means for where we go next is a masterclass in understanding market regime dynamics. While American traders were just waking up, China was already in a full-scale physical gold buying frenzy that literally broke the digital infrastructure of their largest e-commerce platform. But here is the open loop that should make every Western investor pause. While the paper price in the West is sitting at 5,346, physical gold stores across China have stopped selling investment bars entirely. They're only offering decorative craft gold at the equivalent of $6,329 per ounce. Let that number sit for a second. That is a $1,000 premium on physical gold in Chinese retail stores because they have run out of investment metal to sell. This isn't a technical divergence. It is physical scarcity showing up in the world's largest gold-consuming nation. But why did the e-commerce platform crash? And what happened when 336 trillion yuan in savings tried to move through a single door at once? Jingdong Finance, running gold accumulation products in partnership with Dasheng Bank, crashed this morning the moment the markets opened. The system suffered severe congestion. Users were unable to log in, and those who did were unable to purchase. China has 336 trillion yuan in household savings. A significant slice of that capital tried to move into gold simultaneously, and the digital plumbing simply couldn't handle the pressure. Every major bank is reporting a gold buying rush, and every Chinese gold miner hit the daily limit up within minutes. This isn't quiet accumulation, this is a stampede. But here is the divergence you need to watch. Chinese miners are limit up, but Western miners are not following yet. Historically, mining stocks amplify the move in the underlying metal by 3 to 5 times. The fact that Western mining stocks are lagging behind the physical reality in the East is either a massive opportunity or a final warning. The ones who do their homework are going to figure out which one it is faster than everyone else. But let's zoom out to the force multiplier behind this move. Iran has now struck 15 different countries or military installations. Israel, the United Arab Emirates, Saudi Arabia, and Qatar have all been hit. This is no longer a contained regional conflict. It is a multi-front military engagement hitting the world's most critical energy infrastructure. But here is the open loop that the energy markets are failing to price correctly. Saudi Arabia, ES Ras Tanura, the largest oil refinery in the kingdom, processing 550,000 barrels a day, has halted operations after a drone strike. Simultaneously, Qatar's liquefied natural gas complex has been hit and production has stopped. Qatar accounts for 20% of global LNG supply. European gas prices just exploded 47% in a single day. If 30% of the world's oil and 20% of its gas is effectively offline or frozen, why is the oil price currently going down on your screen? Someone is working very hard to hold that number down. But for how long can you suppress a literal energy famine? The answer lies in the growth scare dynamic that is currently tearing the silver market apart. Oil gapped 8 to 9% higher and is now fading, drifting from 73 down to 70. As Mark Douglas wrote in Trading in the Zone, there is a distinction between what the market should do based on fundamentals and what it actually does based on positioning and control. The paper in a short stack on oil is doing exactly what concentrated short positions always do. They are buying time while physical reality builds pressure underneath the surface. This connects directly to the separation between paper markets and physical reality. This morning, gold and silver split. Gold is up on the day, but silver got slammed at the New York Open, pushed aggressively below $90. There are 2 reasons for this. The first is macro. This is a supply shock, not a demand boom. A sudden supply shock creates a growth scare. When growth fears dominate, industrial metals take the hit. Silver derives 60% of its demand from industrial applications like solar, electric vehicles, and defense manufacturing. Energy disruption of this scale hits those demand projections directly. Gold doesn't have that problem. It is purely monetary. But the second reason for the silver slam is more clinical. A nearly 8% dump from the highs, concentrated right before the New York Open, isn't just macro. It is macro with a heavy hand on the scale. Markets have a habit of doing the exact opposite of what the crowd expects. When silver closed at 94 on Sunday, sentiment was at moon levels. Everyone thought we were going to all-time highs the next day. But here's the open loop that identifies the predator in the room. When sentiment peaks like that, you get exactly what we saw today. A flush that shakes out every late entry and resets the crowd's conviction. Sentiment is a weapon when you are the one with size. We know who holds the largest position in the SLV Silver Trust, Jane Street, with a $1,300 million position. If you are a quantitative firm with that much size, are you a passive holder? Or are you extracting edge from the very traders who just bought the $94 breakout? We're about to look at the 150-day moving average and why the support found at $88 is the most important number of the week. If you pull up the hourly silver chart and add the 150-day exponential moving average, you will see exactly where the slam stopped. When silver was hit at the New York Open, it found support at $88, right on that moving average. It has since bounced back to 90. This level is critical. If silver loses the 150 EMA on the hourly and fails to reclaim it, the price can drop to $84.90 and below. That is a number that will shake out the weak hands who expected a straight line to 100. However, look at the divergence. Shanghai spot silver is sitting at $102 right now. Western spot is at 90. That is a $12 premium that remained intact even after the New York attack. Shanghai futures are even higher at 105. The premium survived the New York Open. This tells you that physical demand in Asia hasn't blinked. The paper price went down in the West, but the premium stayed stable, which reveals where the real conviction is located. But here's the open loop for the mining sector. If you think the paper slam is the end of the move, why did Chinese gold miners hit their limit up during the same session? Why is the largest e-commerce platform in the world still struggling with congestion as people try to buy metal? The heavy hands know that retail traders look at the price on the screen, but informed money looks at the vault. If Jane Street or other quant firms are using their size to engineer these flushes, they are doing so to clear out the leverage before the next leg up. But there is a danger in this game. If they dump too hard into a physical vacuum, they risk losing control of the physical to paper arbitrage. We are about to look at the 10 consecutive monthly green closes and the final Boltoro-Styles supply terror signal coming out of the European natural gas markets that suggests the real explosion hasn't even begun. We must call this what it is: financial warfare. Iran isn't just launching drones, it is systematically targeting the economic plumbing of the world. By taking the largest Saudi refinery offline and freezing Qatari LNG, they have effectively removed 30% of global oil supply from the board. European gas prices rising 47% in a single day is a supply terror signal. It is a market pricing in a genuine winter of energy scarcity. This isn't about numbers on a screen. It is about the physical ability to heat homes and power factories. Precious metals aren't reacting to headlines. They are reacting to what informed money already understands about this new regime. In a growth shock environment, the order of operations is gold leads, then silver, then platinum, then copper. The more industrial the metal, the harder it struggles until growth uncertainty fades. I specifically told you in the last video that gold would lead this move, and that is exactly what we are seeing. But here is the open loop that exposes the manipulation. Why is oil being suppressed while 30% of its supply is disrupted? Why was silver slammed for 7% right before the New York Open while physical stores in China were running out of bars? These things do not happen randomly. They happen when a system is trying to buy time to settle contracts before the price discovery becomes too violent to manage. The structural silver deficit, marked by 10 consecutive monthly green closes before this week, has not changed. The scarcity hasn't gone away. It has just been hidden behind a paper wall. We are about to reveal the final strategy for the $84 downside risk, and the one signal that will prove the Chinese stampede has reached the western shores, a signal currently hidden in the western mining stock divergence. Let's be intellectually honest about the risks. Silver dropped 8% in under 2 hours this morning. That is a significant technical break. If the $88 level fails, we are looking at a move toward $84.90. Gap fills are a real technical phenomenon. We gapped up, and now the market is filling that space. If Western mining stocks continue to ignore the limit up moves in China, it could be a warning sign that institutional money in the West is not fully committed to the breakout narrative yet. However, nothing has changed in the physical world. China had a gold buying stampede that crashed their largest financial platform. Physical stores are out of investment bars. 336 trillion yuan in savings is looking for a store of value, and it is pointing directly at gold and silver. The Shanghai premium is still $12 on silver, and physical gold in China is $1,000 above the Western spot price. The strategy is simple. Do not trust the paper noise. The Middle East situation is moving fast, and the big one hasn't even arrived yet. If oil is being suppressed today, it is only creating a more violent explosion for tomorrow. If silver is being slammed at $88, it is only creating a deeper value zone for those who understand the physical deficit. But here is the final open loop that proves the Western wall is about to crumble. While the paper price was being smashed, 3 major Western bullion banks just moved 42 million ounces of silver from registered to eligible total status. Why would the banks pull their metal off the available delivery list right as they are slamming the price? The answer is that they aren't selling to you. They are hiding what's left before the March delivery window slams shut for good. Invest with logic, not hype. Trust the data, not the screen. OG out and about.